Hello, I'd like to take a moment to explain the shift in bond values over the last 12 months. In 2023, they were both very challenging years for bond investors. While the broader markets reached new highs, most bonds could not keep pace, primarily due to the economic shifts and the rapid rise in interest rates by the Federal Reserve Board. Here's some key points. 2022 was the worst year on record for bonds. We're going to show you some stats in a minute that are unbelievable. And it is largely, in my opinion, due to the Federal Reserve rapidly raising interest rates so aggressively, which clobbered bond prices, especially long-term bonds. Watch this. Look at these returns for 2022. Intermediate term U.S. Treasuries, Treasury bonds. Last year, down 10.6%. The previous worst, 5.6%, almost half. Total bond market down 13%. The worst before, down 9.2%. Watch this one, long-term U.S. Treasuries. Wow. Last year, down 29.3%. The previous worst, 17%. And that was, look at those two dates, March 1980. And long-term investment grade, corporate bonds, down 27%. The previous worst, I'm going to call that 23%. 2022 was the worst market for bonds, and in this case, 43 years. Now, why did this happen? I believe the primary reason was the Federal Reserve Board's rapid increase in interest rates. Past data shows a direct correlation between the Fed's decisions and the performance of such assets. So look at this chart for a minute. On the far right, that big mountain, that's President Jimmy Carter and Federal Reserve Board Paul Volcker. Rates, short-term rates got to over 21.5%. Mortgages were 15 and 16%. Long-term treasuries were 14 and 7/8. Municipal bonds were 12%. And you follow that chart from 1980 and essentially up until 2008, with a few bumps, they were going down the whole period. Then from 2008 until last year, with a little bump in the middle, interest rates stayed flat. Then look at the big jump at the end. In 12 months, in 1 year, we went from 0 to 0.25% to 5.25%. That is a 20-fold increase in interest rates in 12 months. Now, here's what happens. You always have to remember this fundamental. The first thing up there, when interest rates rise, bond prices generally fall. Conversely, when interest rates fall, bond prices rise. So let me give you two examples. This is when rates rise. Suppose you own a bond that pays 5%. It's fixed and it doesn't change. Interest rates rise. Now, new bonds, let's say they're issued at 6% because rates have gone up. If someone is looking to buy a bond, they would rather buy the new bond at 6 than your old bond at 5. Well, the price of your bond, in order to entice someone to buy your 5% bond, you may have to lower the price to make it more attractive. By lowering the price, the effective yield to the new buyer makes it competitive with the 6% returns. And by the way, it happens on the other way also. Let's take the same thing though when interest rates fall. Suppose you own that same bond at 5%. Interest rates fall to 4%, your 5% bond becomes more attractive. So now, to buy your bond, which offers a higher yield than new bonds, investors are willing to pay a premium. That drives the price of your bond up. In summary, you always have to remember, bond prices and interest rates move in opposite directions. So here's what gets affected by that. It's everything that's income oriented. Corporate bonds, dividend stocks, mortgage bonds, REITs, municipal bonds, real estate investment trust, U.S. treasuries, anything that is income sensitive. So, last year's unprecedented, a rapid increase in interest rates led to the significant market adjustments. Remember, we went from a 0.25% to 5.25% in 1 year. Wow. And despite your bond income remaining consistent, many of you have noticed that the market value of your bonds had to adjust to the new interest rate environment. And as I said earlier, I believe this adjustment was a direct result in the market's reaction to the Federal Reserve raising rates so quickly. So, why did they do that? Well, rising inflation was a priority for the Federal Reserve Board, who used interest rate hikes as just one of their tools to control inflation. Inflation peaked in June of 2022 at 9%. Now, the Fed's tightening strategy is aimed to lowering inflation to a 2% target rate. Well, we all know inflation has declined, but it's still above their target 2% rate. So, what should you do? First, it's important to understand the relationship between interest rates and bond values. You may want to look at your portfolios to see if there's any changes and decide whether to hold or to adjust your positions. But there is a silver lining. Take a look at this chart. These are the declines in rates after the last Fed hike. We believe we're either there or very close to it. So what we've learned is we may be very close to the end of this cycle. Historically, buying bonds near the end of a rate hike cycle result in stronger returns than waiting. And over the past 4 cycles, waiting longer to allocate after the final hike resulted in lower returns in the subsequent 1 and 3 year periods. So, our commitment to you, we are dedicated to providing you with the best advice and the best strategies to navigate these challenging times. So, we're always here to assist you. Don't hesitate to call and talk about your individual situation. But I wanted to answer the questions that many of you have. By the way, here's our 4 other on-demand workshops you may find useful: estate planning, taxes and retirement, navigating Social Security, and savvy IRA planning. So if you would like to speak to me individually, please just call, schedule a personal meeting, a video call, or just a phone conference. Because remember, as always, we're here looking out for you.